Laurence Balanco joins us now. Let's take a conversation forward. Let's understand from him that where he feels that the big picture for equity as an asset class is, and in general how things are stacking up for Indian markets. Laurence, good morning. Thank you for joining us.
Morning. Thank you.
India is underperforming this year, and India outperformed massively last year. Why is that happening? And do you think this could be the trend for rest of the year as well?
Well, our base case is that we're expecting to see further volatility in the trading range that the Nifty set up, basically from the peak that you made in late 2021. And that range, unfortunately, is fairly wide. We're talking about a 15 to 70% wide trading range, which has provided support around that 15,400 area for the Nifty and resistance up at the 18,600. The positive short-term setup is that we did find support at the 16,700 area on late last week, and we continue to hold that in early trade on Monday. So best case scenario is that we're holding the upper boundary of that trading range. The fact that the Nifty remains trendless would suggest that at least for the next 2 quarters, we're likely to see further relative underperformance if you look at it versus an EM basket at least.
In this bout of underperformance, Laurence, what are the levels that you're monitoring on the index? What's the target on the downside and the upside for the remainder of the year?
Yeah, remember, it's a relative call, so we can continue to hold the 16,800 to 18,600. That would be the best case scenario. The weakest scenario would be a break below the 16,800, and that would open the door for a move to the bottom of the range, which comes through at the 15,400 area.
Do you think the bull market in India, which let's say started in April, May 2020, that's over now?
I think from the longer term perspective, the trends are still very positive for the broader market, and we still got upside targets of 20,700 to 20,800. But we have mentioned before, that it's not uncommon for the Nifty to spend a number of months, if not years, trading in a range. When you can go back to the 2010 to 14 scenario that you consolidated the gains of the 2009 lows before you broke out in 2014. And then you saw a similar 12-month period between 2015 and 16 where the market digested the gains following the breakout from 2014. And currently we're pushing on to 16 months of a ranging period, and that could extend for another 6 months at the very least, but it doesn't alter the longer term structure, which remains bullish.
Laurence, I wanted your take regarding a couple of these sectors which have been defensive and underperformed, pharma and FMCG. Do you see the risk reward being favorable, and would you be suggesting a long or a positive recommendation on these 2 sectors?
Well, I think in relative terms, at least the fast-moving consumer goods side does give you that relative outperformance that you've seen. And the reason why that's been generated is that the sector's managing to hold up in a higher range. The pharmaceutical side, unfortunately, that remains in a downtrend. Yes, we have had a rebound over the past few sessions, but the broader trend is down in both absolute and relative terms. And one of the sectors we've been highlighting as take profit or sell has been the auto side. We had great outperformance last year. That's rolled over, broken down. So we'd continue to recommend reducing exposure to that space. And another sector where you're at least getting some relative outperformance currently is from the IT side. That's not because you've seen a breakout in absolute terms, but it's the trading range that you've seen there at least generate some relative outperformance.
It's interesting that you say what you did about both IT and autos, and I'm going to pick it up one by one, Laurence. Let's first talk about autos, because we've had a great past year for both TVS Motors as well as M&M, that's Mahindra and Mahindra. And then Tata Motors has been a bit of a flat performer, so to speak. In the year ahead, do you think there is going to be a shift, money moving out of M&M, finding its way into Tata Motors or a Maruti, which also has seen a bit of an uptick? Or do you think it's a complete avoid that you're suggesting right now for autos?
Yeah, Mahindra again had been the big breakout that you saw early 2022. It met its upside target. And if you look at the chart over the past 2 quarters, you've seen a triple top pattern and a breakdown from that with a recent break below the 200 days. So we do think there's further downside risk for Mahindra. Mahindra would be a seller on that chart setup. Yes, Tata Motors is holding in the trading range, so you can potentially get some relative outperformance from that. TVSL is another stock that does show another potential topping pattern and would reduce exposure there. So as I said earlier on, I think the auto sector in general as a sector to reduce exposure to and look at least the IT sector as a relative outperformer currently.
You know, it's interesting what you say about IT as well, Laurence, because, they've had a long patch of underperformance, right? What within IT are you recommending then?
Well, you have to look at the large cap Tata Consulting, which is holding in the trading range. If you look further down the market cap side, you have seen weakness in Wipro. So it's really about staying in the large cap Tata Consulting that's holding its range. That's where the relative outperformance is coming from.
What about Reliance? It was giving us that false hope of maybe hitting a fresh record high, but then it's completely gone sideways.
Yeah, it's almost identical to the Nifty outlook. We've been in a trading range since the third quarter of 2021. I mean, the interesting thing, as we've highlighted recently, it's bottom end of its range, downside momentum slowing. So we do think that does hold support and rebounds off the support level around the 2100 area to remain range bound. So accumulating down here, I think is a good risk reward entry point.
Laurence, for a market like India, and you've tracked this market for years now, how many times we've seen this kind of a distribution stroke time-wise correction? How many times do you think that has occurred in last 10 years, and what has happened after that?
Well, again, if we just take a step back and we look, we start at the 2009 low. We had over 170% gain off the 2009 low. It peaked in 2010. It took just over 4 years to consolidate that in a range. And within that range, you saw price swings of 20% down, 20% up. And that took 4 years before you broke out in the first half of 2014. You then had a big run up of roughly 40%. You peaked in late 2015 and you spent the next 12 months consolidating. And then we ran up in a breakout in 2016 all the way through to 2019 before we got hit with the COVID correction. So we've seen two major periods of multi-month trading ranges before the longer term uptrend resumed. And that's, we've seen the third major trading range setup, which was developed off the third quarter of 2021 highs. And like I say, our base case is that this trading range probably lasts for another 2 quarters before we can look for a confirmed breakout and resumption of that longer term uptrend.
Laurence, where do you think, in terms of the turning point for commodities, will come? Crude is not at 130. It's already down from a bear market. From a bull market, it has moved to a bear market. Where is gold headed and where is crude headed?
Yeah, so let's deal with crude first, because last week we did see a break below $80.40, which was a key short-term support level. That does now extend the downtrend that you've seen develop off the early 2022 highs, and it suggests a move back towards the $65 area, which is basically the lows that you made in the first half of 2021. So that is the downside risk on the Brent side. Gold, on the other hand, we've seen a trading range since August 2020, and that trading range has developed below this 2100 resistance zone. And the setup now is for gold to at least test that area, and a break above 2100 would give us a fresh upside target and breakout and give us a target level of 2500 to 2550. So we're watching gold quite closely for a break above that 2100 area and a move up to 2500 at the end of the day.
That's quite an upside on gold from 2100 all the way to 2600. But Laurence, when we spoke with you at the end of last year, we were talking about a Nifty target of around 21,850 to 22,000 thereabouts. Do you think that's got shifted materially to, let's say, end of next year?
Yes, I think as far as the time horizon goes, the fact that we failed to sustain the breakout in December and the fact that we've pulled back into this trading range does postpone rather than negate that upside target. And like I said earlier on, I think this ranging action lasts another 2 quarters at least. So yes, those upside targets are pushed down the track.
You also talked about as to how India is going to underperform in the emerging market basket. So what will hold up, Laurence? And would it be an obvious China trade that's going to work?
Yeah, unfortunately, when you do see China, which makes up 40% of the EM index, as we broke out from the October lows last year, the mere fact of the gains that you saw in China had India underperforming, even though you didn't see any meaningful breakdown in India. It was more of that ranging action. And if you look at the MSCI China or the HSI, you've been sitting on this key support area over the past 2 weeks, and we started to react in a positive fashion off those support levels. And we've got a number of signals that have developed on that recent correction in the Hong Kong China side. So we do think there's definitely immediate sort of upside potential from these support levels in the Hong Kong China side. And that's on a relative basis would see India underperform, even though it holds in the current trading range.
Okay. Laurence, if one has to, let's say, take a 3-year view from here till, let's say, 2026, middle of 2000 or beginning of 2027, do you think Indian equities, the long-term charts still indicate that there is money to be made here? This market will do exactly what it did after these brief patches of consolidation?
Yeah, absolutely. Like I said earlier on, the longer-term structure hasn't been damaged at all. And this trading range then would set up a platform for a resumption of that trend. In the short term, though, it's more about tactical swings and rotations within the underlying sector. But from a longer-term side, it's still a positive setup for, a push through 20,000 and move up to the 21,800 area and potentially even higher than that. So longer-term trend still intact. It's just about digesting the gains of the 2020 lows. And the common pattern has been a sideways range over a period of time.
Laurence, you talked about, the fact that 16,800 also is a very key support for the index. And you've obviously highlighted your longer-term upside target as well. But in this kind of a scenario, what happens to the mid and the small cap indexes here? Do they drag more from even the current levels? Because they already have, even year to date, or for that matter, on a 52-week basis.
Yeah. Unfortunately, as we've seen in the US, the small cap side does underperform, typically falls more when you are in these corrective periods. So, looking at the Nifty small caps and even the Nifty mid cap side, you are seeing that relative underperformance. And they are already back towards the lows that you saw in mid-2022, rather sitting in the middle of the range, which the Nifty is. So we don't see any signs of relative outperformance in the immediate short term from that mid and small cap space. We're likely to see further underperformance.
While you did talk about your upside target of 20,700, you are highlighting a possibility that there might be a 15,400 kind of number that might be there on the Nifty as well. What's the probability of that?
I think that's really going to be dictated on how the developed markets trade, and the 16,800 area we'd put to the equivalent level of 3,800 for the S&P, which is basically gets December lows. So if you look at the S&P over the past 4 months, we've seen this trading range between 38 and 4,100 shows. So should the S&P break below that 3,800 area, that would increase the probability of a Nifty break below 16,800. And for the S&P, a break below 3,800 really opens the door for a retest of the October lows, which is around that 3,500 area. So that's really where the risk of the Nifty retesting that 15,400 increase significantly on an S&P break of 3,800.
That's right. Now,
Okay, Laurence, we'll let you go on that note. Thank you so much for joining us this morning. For the market, there is a bit of bounce back, which is visible. We are above the 17,000 mark, so 70-point upside coming in for the Nifty. The Sensex is comfortably up around 200 points. And there is a bit of a positive, tilt towards the mid-cap as well, because that also has moved into the green. Even if you look at the advanced decline ratio, that continues to be in favor of declines as we speak. 1,100 stocks to the declining side versus 760, which is advancing. The